Welcome to the Overberg Asset Management Market Review.
Good day, I'm Carel La Cock, COO and Director at Overberg Asset Management, based in the Hermanus office. The US market sold off quite heavily. I think I read somewhere it was the worst sell-off since September 2020. Why did markets react so badly? Because inflation came in higher than expected. I think also the core consumer price growth, which excludes food and energy, those volatile items, that was also up from 5.9 to 6.3. So that core consumer price went up, the headline figure went up, and all of this points to the Federal Reserve probably having to hike interest rates more aggressively or for a longer time than the market anticipated. So I think there's a general feeling in the markets that things aren't going to be quite as bad. The Federal Reserve's making a lot of noise saying they're going to do all these rate hikes, but inflation is going to come down with the sort of the rollover effect. So as the base effect, as time marches on, the base effect will just naturally bring inflation down. But we haven't seen it this time, and I think that kind of spooked the markets. So yesterday morning in the bond markets, the 2-year treasuries, they were up as well and they're currently at 3.74%, while the 10-year treasury stood at 3.43%. So there's a slight inversion of the bond yields. What did we learn from sort of the market pricing? Markets are still pricing in another 75 basis point rate hike at the end of September and further rate rises in November and December. So I think, all the noise and the rhetoric that the Federal Reserve's put out there, I think all of that will probably come true. So the current target range of 2.25% to 2.5%, and the markets are probably expecting now sort of a terminal rate of about 4%. So there's quite a bit of rate hiking still to come. Then over to a recent report from MRB Partners. They released their asset allocation strategy at the end of last week, and a summary from there follows here. So in their report, they say that the bond markets and equity markets will remain volatile as investors are quite uncertain about global growth and monetary policy. And I think we saw quite a good example of that yesterday. They expect the global economy to regain its footing in early 2023, aided by the rolling over of inflation. And MRB's view is that equities will outperform bonds on a 6 to 12 month basis. Then they also highlight there's likely to be earnings downgrades in the coming months, which will weigh on equities until central banks signal a pivot away from hiking cycles. So we kind of know the story of what will be happening with central banks. They set out to hike rates. The other part of it, of the valuation, is obviously still earnings, and I think thus far earnings is held up. But I will discuss earnings a little bit further down here as well. Obviously, as earnings downgrades happen, the economies are slowing down, companies making less profits. I think they feel that equities can come under further pressure once we see companies reporting lower earnings. Then on the commodities, they view it as poised to weaken further, while the US dollar bull run will continue, but will move slightly lower over the course of next year. Coming back to the earnings story, so this from MRB, the global 12-month forward PEs is currently at a 2-year low, and it remains quite sensitive to the US interest rates. At just under 15, it's more consistent to mid-cycle slowdown than an economic recession. So it kind of means stocks aren't cheap by historical standards, but also not expensive. their view is that stocks will still get modestly cheaper until the central banks start easing their hawkish rhetoric or investors become more confident that the global economic growth regains its footing. Also, speaking about earnings is Robert Armstrong writing for the Financial Times, and he notes that earnings have actually held up in the face of inflation and the threat of a slowdown. According to FactSet, earnings of the S&P 500 companies actually grew by 6.3% year on year in quarter two, and that's near the historic average. So profit margins in Q2 remained more than 1% above their 5-year average at 12.3%. So what does all of this mean? Costs are rising, but companies have pricing power. He does caveat, however, that earnings are currently being distorted by the energy sector. So if we strip out the energy sector, that 6% or 6.3% growth in earnings actually translates to a 4% decline. So the energy sector obviously contributing a lot to earnings growth. Other cyclical sectors also not doing so well. Financials, earnings down 23%, while consumer discretionary earnings down about 18%. So he's saying that, revenue figures currently are being puffed up by inflation, and, the energy sector revenues or Q2 sales growth for S&P came in at under 1%. And that's according to data from the Bank of America. So that being said, earnings currently not falling off a cliff. Survey data and real-time economic measures suggest that economy actually remains relatively strong in Q3, and that's the US economy. Then just finally, a trend that's been going on sort of from the beginning of the year, we've seen sort of this trade US versus EU. Investors have been pulling funds from EU ETFs, and in August, that number of outflows came to $7.7 billion. And it was actually the sixth consecutive monthly outflows from EU ETFs. And that's according to data from BlackRock. On the flip side, investors have been piling into US stocks, and those US stocks currently actually seen as sort of a safe haven. So in the four of the last 6 weeks, we've seen inflows into sort of US funds. So why is that happening? In the EU, we've got these expected energy shock that will come this winter, and it's largely seen that will drive the EU into a recession. In the US, it's seen that there might be a delay in the recession, or that the US could actually get away with just a slowdown and not a full-blown recession. The mix of industries within the different indices, the EU and the US, also makes a difference. So in the EU, equities are more sensitive to economic cycles, where in the US, there's more big tech, pharmaceuticals, and consumer staples. So obviously, if there's an energy shock and that causes the global economy to slow down, that will be quite negative for EU equities, which is more sensitive to that cyclical, versus the US, which might do a little bit better. Also impacting this trade, or a reason for that, is rates. The US central bank is seen to be ahead of EU central banks when it comes to the rates hiking cycle. It's also seen that, if the EU ends up going into a recession, the central bank might have to ease off on the rate hiking cycle, and that will actually cause the US dollar to strengthen even more. So I think investors also prefer to be in US dollars rather than in euros. The comment from Robert Armstrong for the FT that sort of notes all of this is saying that although that's been the trend, it's almost that trade is a little bit late now. So if you're thinking of selling Europe to buy US, that trade, time has kind of passed for that. It's almost time to start thinking of the opposite. Anyways, that's it from me. I'll hand over to Gielie now to chat about the local markets.
Thanks, Carel, for your summary. Locally, not much has been happening. MTN, we own MTN. There's some good news from them. The Nigerian government has suspended the implementation of a new telecommunications tax, which would have helped to reduce the country's budget deficit. Many of these countries in Africa, they got telecommunications taxes, which is really hitting the firms like MTN very hard. So it's a big positive for MTN that Nigeria won't have any communications tax. Transaction Capital, which we hold, is one of our better companies. I mentioned it last week, but final figures are now out. They've had a capital raise of 1.28 billion. It was massive. It was heavily oversubscribed. They sold, so they issued 36 million shares at the average value of 35.5 rand. Then from Anglo Platinum, not so good news. They've got production problems, and they expect their production for this year to drop to about 10%. It will come down from about 4.4 million to just below 4 million ounces for the year. It's not very good. First, the rand, they've had several updates. The latest update is that their HEPS, their headline earnings per share, for the year to June will rise between 20% and 25%. The final figures will be out tomorrow. Then Process, they are still continuing with their plan to cut back on their stake in Tencent. They own 29% of Tencent and they've sold another 1%. They now own 28% of Tencent. Reinet shares, we own Reinet shares, but not in our growth portfolios. We've added it to our growth portfolios during the week. Carlos, thank you very much for that, for fitting in time to do those purchases. And then the following net selling of shares on the stock exchange. Last week it was 60 billion rand. Year to date is up another 5 billion rand. It now stands at 65 billion rand years to date. And then statistics that came out. The most important one is the GDP growth figure that came out. There was no growth. There was actually a decline in our GDP figures for the second quarter. So these figures are quarter on quarter, and the drop was minus 0.7%. But they expected it was caused by the floods, not riots, but floods definitely, and then load shedding. The business confidence figure came out. That was for the third quarter. Very quick, it's already the third quarter. It came down from 42 points, index points, to 39 points. And the consumer confidence index, that also for quarter three, the old figure was minus 25. It actually went up to minus 20. So that was a bit of a positive. Our current account in quarter one was, in round terms, it was 157 billion. And they expected it to come in at about to drop to 100 billion. But it didn't drop to 100 billion. It dropped to minus 87 billion rand. Mining production in July, it went up from minus 3% to plus 3%. That's year-on-year figures.